Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. And welcome this evening. You can find him on Twitter at the Dividend Guy. I'm going to throw it over to the Dividend Guy to give himself an introduction.
Hey Dave, thanks for having me. I'm actually kind of funny because I inherited the Dividend Guy moniker because I actually bought the blog. So back in 2010, back then I was like buying and selling blogs and had like the Financial Blogger as one of my personal finance blog as well, and discovered that I could do a business out of it. And eventually, I started to look at some like investment blog, and then I found the Dividend Guy. Decided to make an offer, went well, and that was like pretty much my sideline. Where and I used to be a private banker and a financial planner back then. And in 2016, I decided to take a pause. We jumped on a small RV, my wife and my three kids, and we drove across North America, then Central America, lived in Costa Rica for 3 months.
Oh, wow.
And yeah, that was just a life-changing moment. I was like 35 back then, and just like taking so much time with my family. That was like so much fun. Did
Yeah, that's
crazy thing
great.
like
Lifetime
yeah.
memories for your kids as well, right?
Oh yeah, big time. And the bond that we could created between the three of us and my wife, that was just even today. Like my oldest son is 17. He's actually leaving for Peru during the holidays with two of his friends. So like it just created that urge to travel. And then I
Your
can see my two
passion for
teenagers are like
traveling and
super
learning
happy.
about other cultures. That's great.
Oh yeah. So actually when we came back, I didn't want to come back. My wife neither. So we were willing to sell everything and just go on a trip. And I was building dividend stocks rock back then at the same time. But the kids wanted to see their children. They wanted to go back to school. So we settled down, and I decided to quit my job though, to give me more flexibility, be able to travel a little bit more. So yeah, so here I am 5 years later. Passionate investor, working, like I say, I'm retired from the corporate world, but I'm working like 365 days a year, and I'm just on vacation just as much.
Nice. Awesome. So those of you watching on YouTube can see on the screen, I do have the Dividend Guy blog pulled up, and I'm sure you can find that. I will link that in the description below. And just for context, the Dividend Guy is in Quebec. So if you're hearing a hint of a French accent, that is why.
Yeah, if I don't make sense in grammarly, it's totally normal. It's all right.
Yeah, well, your English is way better than my French, so we'll continue this en
That's
anglais,
good.
s'il vous plaît. Awesome. Well, let's get into it. Basically, as you probably know, I'm sure you've listened to a couple of the past podcasts. It's just very informal discussion. We just go over some of the different sectors, some of the things in those sectors or companies that you like or don't like. And I guess I used to start off. I'm already up to almost I think guest number 17 or 18. I'm almost at guest 20. So in just over a month, this podcast has been going incredible with people willing to, like yourself, willing to come on and spend time with me.
Yeah, you're
So
getting pretty big, actually. I was impressed by the list of like all those people. So I was like, yeah, I need to get on that show because before it gets like too big, and then you'll say, oh yeah,
yeah,
the villain guy is like too small for me. I don't want
you'll
to talk
never
to
be
him
too big
anymore.
for you, man. Never be too big. You're always welcome back for sure, for sure. Yeah, but you're right. It has been an impressive list already, and it's been great. The support from the community, like as we call ourselves, the Div Twit community, the Dividend
Yeah.
Twitter community. The support has just been amazing. The people willing to come on and spend time with me has just been phenomenal. And so, like I said, in the beginning, I kind of just sort of had a format of where I went through different sectors, but now I've realized I need to ask the guest first, what's their favorite sector? And we'll talk about sort of, whether it's REITs or energy or banks or sort of what's your favorite sector in the market, and we can kind of go from there.
It's kind of funny because I'm not sure I have like a favorite sector. More like I really love like very strong dividend growers. So that brought me to have a little bit of overexposure to the tech stocks,
Right.
but not like the new one, like the old mature one that are able to create that balance between able to pay a dividend, grow it, and at the same time still reinvest in the business. So my two largest holdings, or like some of my largest holdings, are Apple, Microsoft, and Texas Instrument, and they were all purchased based on on a similar investment thesis where you have cash flow money making machine that use, like for Apple, they're using their iPhone sales, they're generating so much cash flow out of it, and then they create multiple other side businesses, and sometimes they hit like just a home run, like Microsoft did with the cloud business, which, I mean, at first they were just like spending a lot of money on it, but there were like a lot of competitions there, and they ended up being number two. And now, when you're talking about public cloud service, you have Amazon, you have Microsoft, and all the others are like way back, and
Right.
they have this dominant position. So from time to time they just hit a home run, but in the meantime they're just like growing. And then you have Texas Instrument, which is kind of like an underdog. Nobody knows about it, and it's kind of funny because the first time I heard about it was like several years ago, and it was one of my member at DSR, and he was like, yeah, could you look into Texas Instrument? I'm curious about what you think about it. And I get a lot of my good ideas from questions like that from my members.
Yep.
But the funny thing is, I thought, well, Texas Instruments, they're making calculators, right? Like,
Yeah.
what's like, why in the world would you invest in like such, like something that is about to die? We all have calculators on your computers, on your phone. Why would you need those scientific calculators anymore? And then I started to research the company. I realized that it was less than 5% of their sales were those calculators, but there were big on making analog chips for industrial and automotive industries. And I was like, okay, so that's completely a different type of company. I didn't expect that at all.
Yeah, that's great. I actually had a past guest on where we were discussing how as kids everybody had a Texas Instrument calculator, like, and so that is what you think of that company as, is a calculator company, but as
Yeah.
you mentioned, they're much bigger than that now, and they've grown. And it's very interesting too, like you mentioned Apple, Microsoft, TI, like obviously, the tech industry. And what you touched on there with Apple, obviously they have the iPhone sales, but then there's so much more to Apple with like Apple Pay, Apple Watch, Apple TV. Like they've kind of got this. I'm not even sure what the correct word is for it, but this little like
Yeah, I
bubble
like to
of
call it an ecosystem of products.
that's a
So
yeah.
they're all
See, your
talking
English
to
is better than mine.
yeah, it's kind of funny because I just love how everything is so simple, and how like all products are talking to each other, and then makes your life so much easier. And the quality, it's kind of funny because the only thing I don't have at home is a MacBook, because I just can't understand how a Mac works versus a PC. It just doesn't like, it doesn't get in my head. But my wife has a Mac, a MacBook, and she's been having the same MacBook for like, I don't know, like 8 years. And during that time I had to buy like, I don't know, like three laptops. They're all breaking after 2 or 3 years, or there's no battery or anything. And hers, like, it keeps working very well, and it's like super high quality. So there's also this ability to charge a premium price and make a lot more money out of each product they sell, just because of their name and the quality of their product.
Sorry, I think we're having some audio issues here. Again, I was explaining I'm in a extremely rural area, so I think you're back. Good stuff.
Okay,
Can you
you
hear
never
me
left.
okay?
Yeah, I do.
Okay, no, good. Good. Yeah, I can hear you again. Just a little glitch there. Hope everyone stuck with us. Um Moving on, sort of another sector, one of my favorite sectors, as you may have seen from my tweets and past podcast, REITs is definitely high on my list. I really enjoy RioCan, and
Are we going to talk about Rio again?
you called me out on RioCan on one of my tweets in the last week or so. So let's discuss that.
Yeah, yeah, kind of funny. I never been a fan, mostly because I'm not too keen on brick and mortar retailers in general. And I was not a fan before they cut their dividends. So when they cut it, and when it's not well rated it wasn't well rated at DSR, and I was like, dividend is slowing down, and at one point it just stopped increasing, and that's definitely a red flag. And then the yield started to increase, and that's another red flag. And the lack of funds from operation per share. And I know that now they cut the dividend, the payout ratio is not as good, and they kind of like trying to make that shift towards more residential and like other places, but they're still having like what, like 90% of their revenues are coming from brick and mortar retail. Not
Yeah.
too sure how it's going to fare in the future either. So that's why I'm not a big fan of Ryokan in general.
Okay. Fair enough. I I did buy 5 more shares of RioCan today.
It's all fair. So, but I mean, that's what I like about the stock market in general. I mean, at one point, it doesn't really matter if you're right or I'm right, or at one point we may like both like have our opinion on a stock, and it's all good because there's a market for it. And then some people want to buy it, some people want to sell, and depending on when you buy the stock as well. Because I remember on Twitter you said that you started your position after the dividend cut, so obviously you were in a pretty good situation there to start accumulating. Um, I tend to avoid companies that cut their dividend in general, so it's nothing necessarily related to Ryocan, but I'm really trying to have a portfolio where all my companies are growing their dividend, just based on the
Yeah.
fact that if the company is able to increase its payout every year, well, obviously that company has a robust balance sheet that has like plenty of great factors. They need to be able to grow, whether it's acquisition, whether it's like good marketing, good products, and so on. They need to be able to generate a lot of cash flow, because if not, they will not be able to increase the dividend. So all those factors makes them an attractive company for most investors, regardless if you want a dividend or not. It's more like
Right.
a sign, a consequence of having a very strong business. It's going to lead to dividend growth. And this is what I like. And sometimes, obviously, I make mistakes, and I get caught with companies that cut their dividend, and then I usually just sell on the same day and move on. And I don't want to hear about this one ever again. I don't look at it. I'm just like, you know what? It's part of the game. You cannot hit for 1,000. You need to have a good, decent batting average, but you're never gonna hit for 1,000, and it's all good. It's all
That's a
about
great
that
way to look at it.
diversification. Yeah, I
That's
mean,
that's a
I
great way
mean,
to look at it.
and the point here is it's the same thing as baseball. You need to be able to hit the ball enough time to go on and create points and win the game, but
Yeah.
you don't need to hit a grand slam every single time you're at
Just
the
get
bat.
on
So
base. It's
yeah, just get
Moneyball.
it on
It's
base.
literally Moneyball. Just get on base. Yeah, and that's
it
another kind of great point. And to stick with your baseball analogy of, well, in mine, just getting on base, like start investing. You just got to get on base. You got to get from home plate to first base somehow. And whether you're starting with, $10, $50, $100, whatever, you got to just get started, and you start seeing that snowball effect, relatively soon, where all of a sudden it's like, oh, I've just made $10 in dividends that I can reinvest, or and then uh, depending on everybody's situation is different. Oh, I've
yep.
made $100 in dividends. I can reinvest that $100, or wherever each person is on their own personal journey. But that's the whole idea, is like, just keep making more. Just keep using
And
your dividends to make more.
it goes very fast sometimes, and you don't even realize it. I don't think I ever put more than $200 a month in the RESP for my three children, and And I didn't even start when I had my first son. I took a few years because I had my first son. I was like 23. So at one point, I mean, you're trying to build your career, your family, you're buying a house. So like savings rate has not been. I'm not that like fire guy that was able to put like 80% of its salary aside. And then my son is like my oldest son is now 17. I'm starting to withdraw from the RSP, and I'm gonna generate enough dividend to probably be able to pay for his like all his tuition. Mind you, I live in Quebec. It's not that expensive, but I've built almost $40,000 in RESP investment, and that generates a lot of dividend. And I don't have to do much besides that, and it's gonna work out. So it's just a matter of, like you said, getting started and then never stop. You know, when
Yeah.
I started at the I started at National Bank at the age of 23 when I finished my bachelor degree, and my first boss on my first meeting, he said, "Okay, so in exactly 3 months, you'll be allowed to buy National Bank shares with your paycheck." And back then they were, I think it was like 8% of my salary, and they were buying another 4 or another 8% or whatever. Like they were like giving me some subsidies at the same time.
Like, the
So he's
company was
like,
matching.
yeah, it was matching a part of that contribution. And my boss said, you know what? In 3 months, you're gonna put that, you're allowed up to 8% of your salary. You're gonna put 8% of your salary. Like that's like that's
Yeah.
part of like your task to do. And it was crazy because you start doing that, and then you live on the new paycheck that you get, because that's the money you have in your bank account. And
Yeah.
you don't even think about it. And every time you get a promotion, you start saving more without even realizing that you're saving money, and because you're still living to that same paycheck. And one day I realized, wow, National Bank is paying for my taxes, my municipal and school taxes, and it's also paying for my vacation every single year. Like every single year, I just like, oh, I need a few $1,000, and then I look back and I'm like, oh, I
Oh,
have
there
that
it
in my
is.
account. There it is. So yeah, it's just have to pay yourself first, and it makes some magical effect where you don't have to see that amount in your bank account. So then you just grow. And I actually started my two teenagers when they were 14 and 12. It's been already 3 years now. They're saving every month, like not a big amount, but like a couple of like now they're like $50 each a month.
Yeah.
But they're just growing that base, and they realize. And the funny part is when my youngest one turned 10, Caleb, when he turned 10 last year, the two teenagers told him, okay, Caleb, now you're gonna start saving, you're gonna start investing. And he was like, yeah, I don't understand. And he's like, no, you just follow us and then start putting like $10 a month in that account, and that's it. And he just did it. So I didn't even have to convince him, and they were already like investing by themselves.
That's awesome. That's amazing. Your kids are well on their way. That's great. Like, teaching that financial literacy that isn't taught in schools, or very little is taught in schools,
Yeah.
and and so many parents don't have the financial literacy to teach their kids, but it's amazing that you do, and that you are basically passing that gift to your children, right? That's absolutely incredible. And you did say
Yeah.
something else in there, the 3 key words. The 3 key words: pay yourself first, right? We've all heard it, and we've all been guilty. It's like, "Oh, I gotta get this bill paid. I've gotta get this bill paid." You know what? The bills can wait a little bit. You gotta get your bills paid, but pay yourself first.
You're actually going to find a way to pay your bills anyway. You know, when I came back to Canada after my trip, I obviously didn't have any money left. Like I had my RRSP and my pension plan, but that the goal was not to withdraw money from it. That was like plan B. If I'm about to lose my house, I'm going to withdraw some money from my RRSPs to compensate, but that was not the plan. So I decided to quit my job, and I remember it was kind of funny because like we came back and I was having a beer with my in-laws, and then my father-in-law is like, yeah, but like you can like what's your plan, because can you afford it, like how's your business? And I'm like, no, my business could afford my lifestyle when I was in Central America because it doesn't cost anything. But
Right.
here the business is not big enough, and I don't even have enough money to pay my bills at the end of the month. And he was like, but dude, why would you do that? Like he thought the I was completely crazy. My wife didn't work back then. I had 3 kids. I had the mortgage to pay. I didn't have any like safety nets or any money left. But I thought, you know what? I'm just gonna make it happen. And that's pretty much the same thing as pay yourself first. If you put your priority, and if your priority is saving and investing, then you're gonna figure out a way.
Yep.
And obviously I had to work a lot more than I thought, and that was like a very difficult period. But even then I was able to do it, and I had that conversation with my wife. It's like, you know what, for several months it's going to be like no activities, no restaurants, and I'll be working probably like 10, 12 hours a day, because I need to build that business if we want to keep the house.
Right.
But that was, you just you set your priorities, and then you start working,
Yep.
and no more excuses, and this is what you need to do. And you're going to achieve amazing things without, I mean, like, I'm not special. I just decided this is what I want to do, and I just did it. I just like focused, put all my energy, all my time on something that I love, obviously, and then something that I thought would help other people as well. Because the whole purpose of that membership is to help people. I realized as a private banker, I was pretty much capped to like 200 clients, because you need to be like top notch, being able to answer all their calls and be there for whatever reason. And then I thought, well, what if I can help thousands of people to invest with the same conviction I have, instead of helping like 300 people?
Yeah.
And
Wow.
this is what happened with Dividend Stocks Rock. It grew. We have like over 3,000 members now. It's keep growing very fast, and it just basically it's just like sharing my love and my passion for investment, and especially in case like this year, which is just completely crazy. And
Yeah.
then a lot of people are not used to that, because they kind of forgot what happened in 2008. And since then we had like 3 bad months, and then boom, there's another bull market. And now we're just like, yeah, it's been since the beginning of the year. What's happening? Like, are we really going to lose money? Like, is it going to happen? So
Yeah.
they're
So
seeking for that, like, I don't know, hiking. I like to say, like, I'm a hiking buddy. You go on a hike, I'll be there. I'm not gonna do the work for you, but I'll be there. If you have any
yeah,
questions,
you still have
if
to
you have
climb the
like,
mountain yourself, but
yeah,
I'm there to be climbing that mountain with you.
yeah. And I'm not here, I'm here to tell you it's gonna be good, like it hurts,
That we can get to
yes.
the top of the mountain together.
Yeah, we're gonna get there.
Awesome, awesome. Just gonna one last thought on the pay yourself first idea. Like every paycheck, whatever even just taking $50 off the top of your paycheck every 2 weeks. That $50 is gonna go 10,000% further than $0, right? So just whether it's 25 or 50 or 100 off of pay yourself first off that paycheck every time. And then I think somewhere in there you mentioned you're in a roundabout way got to dollar cost averaging as well, which is again a great um way of just continuing to invest and not really worrying too much about the stock price going up, down, sideways. You just, you know, you buy it at $10, you buy it at $11, you buy it at $9, you buy it at $12, you buy it at 9.50, you buy it at 10.50, and you just, dollar cost average in over time.
Yeah, and the thing is, if you've done your homework on companies that you love, and that you know that the business is doing well, you don't really have to worry about what's the stock market price for today or in 6 months, because it's not going to matter anyway. And it's actually saying that we have this bear market right now. It's about time that we have one.
Yeah.
Just to clean up everything, just to remind even managers and CEOs, just to remind them, maybe you're
The
hiring
price
just for,
doesn't always go up.
yeah, that's the thing.
There's corrections in the market from time to time.
And you always see them like spending money for nothing at one point. And like, even because I worked for National Bank for 13 years, and I was at the beginning of two departments. And at the beginning of a department, revenues are like growing like there's no tomorrow. They're making money, so they're spending, they're hiring, and it grows very fast. And at one point, after a few years, obviously there's no more 40, 50% growth in that department. And then someone somewhere just wakes up and it's like, hey, dude, why are you having like 12 people to pick up the phone? Maybe you can have like only 10 people and it's going to work out the same way. And then they start realizing that, money was just flowing. So managers were just like spending that money. There's just no reason to stop. And one day there's a financial crisis and they're just like, yeah, let's review your plan and your sector and see what's going on here. And then there's just like, yeah, it's not optimized. So it's a good thing we have those bear markets. So managers, everybody can optimize. You can optimize your personal finance. Some people unfortunately went on to taking too much mortgage. That's unfortunate, but at one point we all need that wake up call saying maybe you're spending too much, you can afford
It's a
that.
check. It
Yeah,
checks and balances, right?
that's it. Yeah, definitely.
Checks and balances. Awesome. This has been a great conversation. Loving talking to you. Um, there was another tweet. Oh, National Bank. So I think because of several weeks ago, 2, 3, 4, I don't know how many weeks ago, where I put out the Canadian banking poll, and I think you were the guy that kept saying, "Where's National Bank on this?" And I'm like, "Well, Twitter only lets you put 4 things on a poll."
Yeah, I'm trying to make a big point on national bank everywhere I go. I feel that it's not because it's from Quebec and it's not because I work for the bank, but really, if you look at any chart over the past 3, 5, 10, 15, and I think even for the past 20 years, it has been the bank out of the big six that outperformed everyone and by a wide margin. And there's a lot of reason for that, but because it's small, because it's based in Quebec, and it's hard to compare National Bank to the Big Five, and that I
Right.
totally get. It's like we're not talking about the same size at all there. And
Yeah.
when it was, because now it's pretty much obvious that the government will never let banks merge together or like bigger banks to acquire another, but maybe like 15 or 20 years ago that wasn't a chatter. And National Bank was like the prime bank to be acquired by, I think I heard rumors about all the big five wanted to buy this.
Yeah, I'm sure any one of the big 5 would love to scoop up National Bank.
Yeah, because they have like this very stronghold in Quebec. But what I really like, and you'll see it's a recurring theme about a lot of stocks that I love, is they use that strength where they have a leader position, a dominant position, and then they say, okay, so we're not going to grow in outside Quebec in the rest of Canada by opening up branches because we're going to get eaten alive by TD or Royal Bank or BMO. They're just too big for us. So what we're
Right.
going to do first is we're going to establish partnerships. So they have like partnerships for credit with Power Corporation. So we can think of like IG Financial, Great West Life, London Life. They're trying to be their bank. So there has like this non-competitive agreement where they're not going to go after the investment, but they're going to take all the leverage loans and mortgages and so on. And then they thought, where can we make the most money? And it's not classic savings and loans, it's towards wealth management. So then they created private banking 1859. And it's kind of funny because the last time I checked, they were like fourth in terms of assets under management for wealth, while being like way smaller than any other banks for anything else. But in terms of private banking, they have built an amazing business model. And I worked there for 5 years. So I was like very close to how they built it and how they manage it. And that was just very, very well. Another place they thought where we can make a lot of money, it was with capital markets. And a lot of people love BMOs for their strong results. And a good part of it is also coming from capital markets, which is very volatile though. You have to be careful because you're gonna have like crushing quarters, but sometimes you're going to get crushed by capital market as well. So it is not
Right.
impossible that you have to declare $100 million loss on the quarter. Yeah, I mean, if bad trades goes bad, I mean that's what's happening,
Yeah.
right? Because they play with big
It
numbers.
sounds like such a ridiculously huge number, but then you also look and go, "Oh, whichever, like, say, Royal or BMO or TD," and you're like, "Oh, they just declared a $1.2 billion profit for Q2," and you're
Yeah,
like, Holy, like,
So that
I
$100 million for them, I mean, it's money, obviously, but it's not something that is going to put them in jeopardy or close to bankruptcy or anything. It's just like it's a good job, you know. It's just like, I took it. Okay, I'm not gonna do it again, and let's move on and do another trade, and it's gonna happen. And recently, over the past few years, they started to make acquisition outside of Quebec and Canada. So they bought Credigy, which is credit specialists in the States, and they started with I think it was like a 50% stake in Aba Bank in Cambodia, and now they acquired the entire bank there. And what I found interesting is in Cambodia, the banking model is similar to what they have in Quebec, which is like a later position in a very small market. So obviously, again, a lot of volatility there. And if you're looking for something stable, probably that national bank is probably not the best bank for you. It's probably better off to go with TD or Royal Bank that are like the big guys, well diversified everywhere. And TD is a little bit more classic, and I prefer Royal Bank for its diversification. So it looks a little bit more like a national bank, but at larger scale in terms of like only 50% of their revenues are coming from the classic savings and loans. The rest of it is coming from insurance, capital market, and wealth management. So it's still a bit different. But I just like National Bank is obviously top five in my holdings, and I kept investing in it going forward, just because there's always this, they have like one of the strongest dividend growth over the past 10 years, and they have one of the smallest payout ratio right now. So they have like plenty of room, and they have been among the most generous. So forget about the yield, focus about the growth, and I think you're going to make a lot more money this way.
So, great point there. And I've mentioned in several of my past podcasts now that I've been very guilty of being that guy that chases the dividend yield, the high yield. And I definitely am now more trying to focus more on the dividend growth and exactly what you said. Moving on, another sector I love talking about are the telecoms.
Mhm.
The big three in Canada obviously are Bell, Telus, and Rogers. Any thoughts on? I don't think you've ripped me on any of my telecom tweets. You've
I don't know. Have you ever said that you love Shaw or Rogers?
no, I have
Okay,
not.
so there you go. Yeah, I don't have any affection for those two. Um, I understand the attraction for Bell if you're looking for what I call a deluxe bond, meaning that you have like those companies like Bell is one of them, Power Corporation is another one of them. Like those generous yield that they're still going to increase, but when you buy Bell, you don't really expect the stock price to go that high. Like it's more about the dividend and a decent growth. So that's why I like to call it a deluxe bond, because the price will likely remain about the same, little bit growth, but
It'll
not too much.
fluctuate,
Yeah,
yeah.
it will fluctuate, but I mean, you do not expect Bell to grow its stock price by 10% for the next 5 years. It would be
No,
it's not a super powered growth stock, but it's a very solid one. So for my portfolio, I prefer Dallas, but I definitely understand why people like Bell, and I do like Bell as well. It's just different types of investment for different types of investor, which totally work fine at the same time. But I just love how Dallas is trying to differentiate themselves. Like Bell and Rogers, they're very strong with media, and they have their legacy business, while Telus thought, let's go towards artificial intelligence, going to develop market like healthcare and agriculture. Doesn't mean it's going to work out, though. They may not work out that well, but I like the fact that it may become not just a wireless business, but wireless slash tech stock at one point. And I
right.
find it very attractive because I see if they succeed, it's going to be like very strong growth vectors. And I kind of like what they did with Dallas International when they did the spinoff. They received, I think, like close to $500 million from the spinoff, and a lot of investors was like, how come I didn't receive a special dividend or some shares of Dallas International? And I'm like, yeah, you didn't receive anything, but they paid off debts with that money, and knowing how telcos are growing their debts over the past 5 years. I kind of like that
Yes.
sometimes they remind themselves, oh yeah, maybe I should pay a
I need
few.
to pay off my Visa and my
Yeah,
MasterCard
there
and my
you go.
American Express, right?
I
Like,
mean, it's not a game changer, but at least to see that sometimes they're using that to pay off debts, it could be lead to another like good income stream from them.
yeah, nice. Great thoughts, great thoughts. I don't know if you've ever heard me tweet or mention in my past podcasts where right now my thoughts on telecoms, I'm dollar cost averaging into Bell until they pay me enough dividends to buy Telus.
That's good. Oh, but I mean, it's when you build your portfolio, I think it's good also to have a part where, because I like to be 100% invested all the time and 100% invested in equity. So I don't have any bonds, I don't have any GICs or anything else. I like to have stocks.
Yep,
However,
me too.
I think it's important that with across all those stocks, you need those very solid, boring companies that will just like be the pillars of your portfolio,
Like
and
Bell.
will,
Bell's been around
yeah, like
for
Bell, it's a very good example.
100 plus years, right?
Yeah, like Bell, you have the Canadian banks, you have some utilities like Fortis, for example. I
Yep.
mean, and I kind of like, because I have like shares of Algonquin Power, which has been a total mess this year, obviously. But
I have a AQN as well, and
okay, so you suffer as well. There
I
you
was
go.
looking at it today, I'm like, "Oh, do I want a dollar cost average way down on that or not?" And
It's tempting, right?
I could I really kinda wanted to, but I couldn't pull the trigger because it was like, "This seems a little bit risky," and when have I ever thought about that with Algonquin Power, right?
Yeah, but that's the thing, like I have Fortis in my portfolio and I have like other like very solid businesses. So it allows me to take on chances on a company like Algonquin, which is like probably like 2% of my entire portfolio. So even though it lost, even if it loses like 50% of its value, I'm going to be down 1% in my
Right.
total portfolio. So yeah, it sucks when you look at the stock, but for the entire perspective, it's not the end of the world. And I'm not going to do anything until we have Investors Day in early 23. Because right now, I think there are so many things on the table, so many different scenarios, and it's more a matter of knowing where new management where wants to go, and not necessarily if they can afford to pay the dividend or not, because they have enough fund from operation, and they could decide to sell some other assets, they could decide to sell their stake in Atlantica Yield to drop down their debts. They could decide just to keep the dividend stable for a few years and then increase it again. And they could also decide to cut it off and just use that money to do something else. But if they cut it off, it's not going to save the business either. And there's this kind of panic I found where everybody says, "Oh, but they're going to increase their debt and it's going to be like variable debt," because this is what they did. They secured their financing to buy Kentucky Power, and with that secured financing, they paid off their line of credit. So obviously, when they're going to close the transaction, they're going to withdraw that money from their line of credit, and it's going to be variable rate. But everybody seems to forget that they're buying an asset that will generate money as well. It's not just that they're going to rack up more than $2 billion in debts and that's it. There's like people living in Kentucky and they need power, they need to
Yeah.
switch on the light. That's happening over there. So Kentucky Power will also generate money that will help to pay off that debt. So obviously it's not the deal they expected it would have been, almost like a year and a half in the making, because now interest rates are a lot higher. But at the same time, I don't know. I look at interest rates. I look at how like the economy's going, and it would not be impossible to see rates starting to go down in 24, and
Yep.
then they would look like geniuses. So it's easy to smash a company that is already down and say, oh yeah, like that was obvious. It wasn't that obvious. Obviously, I'm not happy with the result. I'm sure you're not happy with the result right now.
Yeah.
And then I mean, I'm not losing sleep over that, but
No.
Obviously, I'm not
I'm
celebrating.
I'm in the same position. I my position with AQN is small, so I'm in the same boat as you that we're not, you know, eh, bringing to another point, like why diversification is so
Mhm.
important. Like you don't put all your eggs in one basket, but at the same time, don't have so many baskets that you have so many eggs that you don't know where all your eggs are. Right? Like you
Yeah,
kind of
it's sometimes hard to find that balance between diversification and I have way too many stocks in my portfolio.
right,
I try to keep it around 30 stocks. And mind you, this is my day job as well. This is my passion. This is my day job. I spend my entire days looking at the market, doing research, and writing about it. So obviously, it's easy for me to follow 30 stocks, but I don't think one should go buying like 50 or 60 or 70 stocks. At one point, you're better off with an ETF
yeah,
instead and not having to bother reading those financial statements at this point.
yeah, exactly. No, I agree 100%. And
But
I would agree that sort of 20 to 30 range, whether it's 25, 27, 23, somewhere in that 20 to 30 range, to me seems like a pretty good, number of positions to keep yourself diversified in different markets. Like we've talked about AQN in energy, we've talked about Bell and Telus in the telecoms, we've talked about the banks. Like, those are kind of all great sectors to be in. REITs, even though you don't like RioCan.
but even then, I mean that's the beauty of it is when you can build that portfolio with stocks in pretty much all sectors or the sectors that you love the most. That's how I approach my portfolio. Is there are like sectors that I really like, and I'm gonna focus on those, and then I'll get some exposure to other sectors, but maybe like 5% or 10% exposure. But the one that
Right.
I love, then I'm gonna be able to boost it a little bit because I know a little bit more. I'm a little bit more comfortable with those. I mean, obviously, I was a banker for 13 years, so I'm very comfortable with Canadian banks. Um, I do those reviews on actually I do a quarterly review on YouTube on their earnings, and I feel very good about having those banks in my portfolio for that reason. But some other people may say, "Oh, I don't understand anything about patents and healthcare and those big pharma," and it's all good as well. It's just you need to be able to invest in things that you can understand.
You see, my co-host has to get some.
Yeah, you have another guess, right? What's his name?
Uh, he's named after the most beautiful place on the planet. His name is Whistler.
Oh, nice. Love it.
Yeah, yeah, it's one of my favorite places I've ever been for sure. Um, without him distracting us, a couple more. We we've talked about so many sectors already. A couple more sectors I'd like to touch. Whistler. A couple more segments I'd like to touch on. Uh, Consumer staples. That's another one of my favorites.
Mhm.
Reason being, I work in the food industry, so I I like the idea that people eat every single day. You need your everybody needs food, so investing in thing. And we've been primarily talking about the Canadian market. Other than off the top, we talked about Apple and Microsoft and TI a little bit, but I mean, there's obviously so many great U.S. stocks in the consumer staple sector: Johnson and Johnson, Procter and Gamble, Costco, Pepsi, Coke, like the list literally goes on and on and on. And there are definitely a few in the Canadian market as well. Personally, I own Pizza. I like Pizza. I have Roger Sugar. I like Roger Sugar because so much sugar goes into everything,
And it's not about to stop, that's for sure.
right? And I have I think a couple others that are sort of like the Pizza one, like sort of the restaurant food chain type. But yeah, I just think consumer staples and food in general is a great sector. What are your thoughts what are your thoughts on that sector?
Um, in Canada, I actually prefer the grocery stores. Like,
Yep,
big fan of Metro. That was like the one that I
nice.
preferred. They
I was
had.
actually gonna mention Metro because I know that's a Quebec company.
Yeah,
And
it is
speaking of
again, but if you look at their growth path, it's just a lot. They grow a lot faster than Loblaws and Empire, mind you. You cannot really lose money with if you have like any of those three in your portfolio.
Right.
I don't have them in my portfolio though. The one that is closer to that is Alimentation Couche-Tard. I'm a big fan of convenience stores.
Yep.
A little bit more like same train of thoughts. Like you need that proximity just to get some snacks, just do
People are
like
gonna eat. People are gonna grab that bag of Doritos
yeah.
at your local Couche-Tard, and then it's like, "Oh, you're getting the Doritos that's my Pepsi stock, and you're buying it at my convenience store."
There you go. It's a full circle over there, and it's great to have those companies like they're like recession resilient, big time. You don't have to worry about them, and actually they've been doing pretty well in 22. Kushtar is one of my largest holdings, and also probably the best performing stock in my portfolio this year, up like 20% or something. So it's
Wow.
always good to have that kind of diversification as well. Never had a chance to grab shares of Costco, but I wish I had. But
Yep.
you cannot catch them all, right? It's not like Pokemon. So
Yeah. Interesting side note, like I said, I work in the food industry, and we sell to Metro, we sell to Sobeys, we sell to Loblaws, we sell to Costco. So, yeah,
yeah,
like, people eat,
and but
right?
when you
People have to eat every day.
yeah, I just think you have to be careful though with like companies like Maple Leaf Food, for example, or Saputo, where their margins are big time under pressure, and it's hard
Yeah,
for them to. I like that's why I like the grocery stores because that's the end of it, and regardless of what's happening behind, people are gonna go to the grocery store and buy. But then if the cheese is too expensive, they're gonna buy something else at the grocery store. They're gonna cut down on cheese and then just buy something else. But Saputo is pretty stuck selling cheese. So they
yeah,
like Maple Leaf Food, they're selling meat mostly. So they're pretty much stuck with their products. And if they get, it's a little bit harder. So inflation has this weight big time on them, a little bit more than those that are selling the end product, like the grocery stores and Kushtar as well.
yeah, awesome, yeah, consumer staples, I think, is a great sector. That's, again, sort of obviously, you're getting some of my favorites, I'm getting some of your favorites, REITs, banks, telecoms, consumer staples. We've already touched on technology as well. Healthcare is another one on my list. NWH I love because it's a REIT in the healthcare sector. I'm killing two birds with one stone, so to speak. So, any thoughts on either NWH or anything else in the healthcare sector?
I'm actually a bit reluctant to invest in those healthcare REITs. Like not before COVID, but after COVID. The problem is occupation is going down, but expenses is going up. So I don't like that recipe, and a
Right.
lot of them are having a hard time generating FFO growth, and because of that, the dividend doesn't move anymore. And especially when you consider inflation right now, even though you receive like a 6-7% yield, I don't know like about NWH. Probably the yield's probably around that level. But if it doesn't increase, where it's been 2-3 years where you pretty much have a passive dividend cut, like it's a silent dividend cut because of inflation. So if inflation is 2%, that's not a problem. If inflation is like 6-7% right now, that becomes a problem, especially over a long period of time. And I'm not sure about those perspectives. Before that, I was like, yeah, they're doing well. And actually, uh, I like Chartwell REITs back then before COVID. They have like senior houses and so on, and they were doing very great. They were increasing their dividend, and I mean, population is aging across North America, so it's a no-brainer. But the problem came from that COVID that completely put this sector on the edge of a cliff. And I don't know. I'm not too sure about the growth perspective because once the baby boomers will be gone, I'm not too sure like how they're gonna like recycle their assets because they're gonna have like too many retirement homes or healthcare homes at one point. I don't know. I'm a bit yeah, I'm a bit on the side on this one.
Yeah, we're just having another little audio blip here, but I think I'm going to have you back here right shortly. And if you can hear me still, which I think you can,
Yeah, I do.
just kind of one final sector that just one final sector that I'd like to touch on is transportation. And obviously in
Hmm.
Canada, the two big ones are the railways, but there's a few other like transportation companies as well. So, any thoughts on transportation?
Um, I actually love railroads. They've been around for more than 100 years, and they're going to be around for another 100 years. And there's no other way. I mean, Canada and the United States are so large; it's impossible to transport goods from like from the east to the west coast. You need trains. You cannot.
Yep.
And I think that both there's always that debate between like CP or CNR. I have CNR, but you know what? It's pretty much like Visa and MasterCard. As long as you invest in railroads, you're going to be fine. You don't really have to pick one. You could buy both actually if you want. I like both. Another one that I've highlighted at DSR in 2016 was TFI International. That was actually just TFI Transport back then. And those, it's a trucking company,
Yep.
highly fragmented market, meaning that there's a lot of like small trucking businesses. And funny fact, when I was a private banker, like my job was to take care of like personal assets of business owners. And even in the region where I live, I had those like small trucking companies, like guys making like 5 to 10, 15 million dollars of revenue, but having like 25 trucks or something like that, like small
Yep.
businesses, but there's plenty of them. So then you have a big guy like TFI buying those trucks, integrating them into their huge business, and it's just like they're able to scale, they're able to optimize their routes to make sure that it's cost them a little bit less to operate. And I think it's just great the way they have built this business. And what I found very interesting is this year they sold a part of their assets, but that was like the less profitable part. So they decided to focus on high margin, like less than truckload transportation, which is like their key segment, their key sector where they make more money. And they
Yep.
said, well, you know what? Let's rack up as much cash flow as possible and focus on what pays the most. So I think it was really smart from management to do that kind of move.
I agree with you 100% that, rails and transportation it truly is the backbone of the North American economy. If without truck drivers and the trains moving goods back and forth across the continent, like without that, all the store shelves are empty, right? So it's truly is the backbone of the economy. And again, I work at a food manufacturing plant. We have trucks coming and going all the time, and a lot of those trucks are containers on chassis that are then getting loaded on rail to be shipped out to Alberta or BC or wherever. And so yeah, that's yeah, I agree 100% that like you said, CP or CN, you, you know, pick one or the other or both, and you're probably not going to go too wrong. I did just have up on the screen here your Twitter account, so you can definitely find at the Dividend Guy on Twitter. Look at you there with 22,000 followers. That's awesome.
Yeah, I've been fortunate. I don't know. I just love this platform. I'm not a big guy on social media, but I do love Twitter. So
You
I'm
like
not too
ripping
big
me on
on.
my tweets.
Well, you know what? I see debating as a sport. It's a
Yeah.
passion for me. And
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 I'm just joking with you here. Like I
yeah, yeah, of
really
course.
enjoy your tweets back to me about like because you've made me think. I'm like, oh yeah, I should think about what he just said.
But that's what I like about Twitter, and it doesn't really matter who's right and who's wrong because at the end of the day, if somebody else is calling me on something, it's gonna make me think. And
Yep.
as you just said, you know, you're just like, oh, wait a minute, he's bringing a good point. Like Dave is bringing a good point. Maybe I should like revise my thoughts about that topic. And you will not reach that level if you don't go and say like the deep, like exactly what you're thinking. You know, if you're not clear with your thoughts and if you're not afraid, just say, okay, I don't like this thought because of X and Y reason.
Yep.
And it's okay that you love it for ABC reason, and it's all fine. And the point here is to be able to exchange that information. And
100%.
you're not like, we're going to be friends anyway,
Yeah.
and at the end of the day, you're gonna keep your rival can. I'm never gonna buy it, and everybody's gonna be happy with that,
That's
right?
right.
But if at this point you're making me thinking about maybe I should review this or that because you brought a very good point, and you do the same on your side, well, throughout this conversation, maybe we're going to stand and we're going to agree on disagree, but we're going to be better investors going forward because the
100%.
discussion will help us to advance. And that's what I love about debating. And I don't know, it's sometimes my wife is just like, you know what, go with someone else. I'm tired of that. I don't, she doesn't like to argue or whatever, but I'm just like, yeah, but it's just fun, you know, just like throwing ideas, receiving
Yep.
some, and you see where it goes.
And I feel that's exactly what, the whole dividend Twitter community is about is, helping each other, giving each other ideas, and like you said, making each other think what's good, bad, or ugly about your your favorite company that you want to invest in, and it's like, "Oh, maybe I should think about," like you said, ABC or XYZ, and yeah, I just think those are, great points. And on that note, I see we're already very close to an hour, so thank you so much for coming on and spending some time on the Passive Income Podcast. I appreciate it so very much.
Dave, it was a lot of fun. I think I have the feeling we could have gone on for like a few hours here.
Yeah,
So, but yeah, I mean, it's thanks for having me. It was a lot of fun, and definitely we're gonna keep that discussion going on Twitter for sure.
awesome. Thank you so much. Again, please, if you're still watching at this point, you definitely have to go down there. If you noticed on YouTube, it's now a black subscribe button. Check out the black subscribe button and then click it.